In the third quarter of 2025, something extraordinary happened, quietly, almost invisibly. China's wealthiest families, the people with access to the most privileged economic intelligence on Earth, shifted $47 billion out of U.S. stocks and poured it into physical gold. No announcement, no press release, no warning, just a silent, tidal movement of capital. So large it hasn't been seen since 2007, and if that date triggers a memory, it should. Because the last time Chinese billionaires moved this aggressively, the global financial system collapsed 12 months later. Lehman Brothers. Credit freeze, market carnage, a world economy brought to its knees. Today, the pattern is repeating. This isn't just diversification, it isn't routine rebalancing. This is what the ultra-rich do when they see a threat forming on the horizon. A threat the public still can't see. They're not guessing. They're reacting to live data, manufacturing orders, banking signals, cross-border capital restrictions, geopolitical pressure points, indicators that normal investors won't see until it's already too late. So what triggered this $47 billion earthquake? The first clue lies inside China's manufacturing backbone. In early 2025, internal reports showed a 22% collapse in AI chip orders, months before any Western earnings calls mentioned it. To the elite, this wasn't just a slowdown, it was a red siren. When the factories of the world reduce orders by double digits, it signals shrinking demand, falling margins, and a rise in global risk. Then came the geopolitical pressure. The US and China are entering the most fragile phase of their financial rivalry in decades. Behind closed doors, China's wealthy fear a scenario the West rarely considers: asset seizures. Just as Russia had billions frozen overnight, China's elites know that in a moment of political escalation, their U.S. holdings could be trapped, or worse, confiscated. So they acted, quietly, decisively, and with a scale only the ultra-rich can afford. But to truly understand why this moment matters, we need to revisit the last time this exact sequence unfolded. In 2006 and 2007, Chinese investors started unloading U.S. stocks. Not loudly, not publicly. They simply exited the door long before anyone else smelled smoke. When Wall Street was still euphoric, when the public believed the boom would never end, the insiders already knew the system was cracking. Back then, they pulled out $31 billion. Today, they pulled $47 billion. History does not repeat perfectly, but it often rhymes with terrifying accuracy. And the rhyme gets even louder when we look at the asset they're fleeing into: gold. Why gold? Why now? Why not tech, bonds, or real estate? Because gold is the only major asset class that does not rely on trust. It does not depend on a bank. It does not require a counterparty. It cannot be frozen, hacked, seized, diluted, downgraded, or printed. Gold has no CEO. Gold has no quarterly earnings report. Gold is the same object it has been for 5,000 years. A store of value when everything else becomes a liability. And every major crisis proves it. During the Great Depression, gold preserved wealth while banks collapsed. During the 1971 dollar shock, gold soared as currencies devalued. During 2008, gold rose while equities bled over 50%. The ultra-rich know this better than anyone. But what makes 2025 so alarming is not just the shift, it's the timing. Because, historically, capital flight moves in three waves. Wave 1 is silent. Insiders reposition their wealth without drawing attention. That is where we are right now. The $47 billion gold tsunami is the signature of Wave 1. Wave 2 begins when institutions, pensions, sovereign funds, insurers start to adjust. They move slower than billionaires, but when they do, markets feel the pressure. Wave 3 is panic. Retail investors rush for the exits. Liquidity evaporates. Markets seize. And the crash becomes unavoidable. The question you must ask yourself is simple. Where am I positioned? Am I with Wave 1? Will I be stuck in Wave 2? Or will I be crushed under Wave 3? Because here's the detail most people miss. This pattern historically occurs 6 to 12 months before a major market event. The data from 1998, from 2001, from 2008, they all share the same timeline. Insiders move early, the public moves late, and the crash hits somewhere in the middle. If that logic holds, then the current shift points toward a stress window in Q2 of 2026. Now, this is not a prophecy. No historian or economist should ever claim certainty, but it is a signal, one with precedent, scale, and velocity. A signal worth paying attention to, because the smart money has already moved. They saw manufacturing weakness before the headlines. They saw geopolitical risk before the speeches. They saw currency fragility before the reports.